Hello, everybody. I hope that you are all safe and healthy wherever you are in the world. And I wanted to welcome you to part of the Leading Through Crisis webinar series that we're doing. And today's topic is specifically about venture capital. My name is Angela Lee. I'm a professor at Columbia Business School, and I teach mostly venture capital courses. I also teach a leadership course and a strategy course. And the background that I'm bringing is actually first as a founder. So I have been a founder 3 times, once during the first dot-com boom and then subsequent bust, and then 2 during the great financial crisis. And so I have a lot of experience, unfortunately, as a founder, dealing with crisis, but I'm also an investor these days. So I've been an investor for about 12 years now. I run an angel network called 37 Angels. Every year we look at a couple thousand companies and invest in 10. And I'm also on the board of 2 funds. And so I share that because that's the context that I'm bringing into today's conversation, both as a founder as well as an investor. So my plan was to cover 3 topics. I wanted to share some overall kind of data and figures about what has happened to the venture capital and startup ecosystem post-COVID. And then I wanted to talk more like qualitatively, what does this mean for those of us who are in the ecosystem and living and breathing it every day? And then I wanted to talk a little bit about our role as leaders, regardless of what our role is within that ecosystem. And I do want this to be interactive. So in Zoom, there is a Q&A function and you can ask questions. And what I'll do is kind of during, in different tranches throughout today, I will break and take time for some questions. There are hundreds of you on this call today, so I might not get to all of them, but please do ask your questions. I would love for this to be as interactive as possible, even though we are having the conversation over Zoom. So diving right in, what are the impacts of what's happened with the global pandemic on venture capital? And so I know a lot of you have seen really scary headlines that look like this, right? Survival of the fittest, the venture drought, the great pause of 2020, lots of really, really frightening headlines. And I want to show you in numbers what are some of the impacts that have happened. So I'd argue the first thing that folks have been talking about is valuation. So just to give you a sense of that data, if you look at this chart, you've got what this shows you is the percentage of entrepreneurs who raised a round as a down round. So last year or 2 years ago, they raised a round at a $10 million valuation, and now they have to raise at an $8 million valuation. So the down round means the valuation's gone down from a previous round to the current round. And so you can see that in 2019, only about 8% of companies were raising in down rounds, and you can see that doubled in February, and it looks like a downward trend, right? So this looks actually like, maybe we're over the worst of it. May numbers have not come in yet. Those will probably come in the next week or so. But this actually looks fairly rosy. And then if you zoom out a little bit, this is that same information, but I just added 5 years of historical data. So you can see, in 2016, there was a little bit of a spike and a little bit of a correction in the marketplace. And so when you look at this, you could say, wow, maybe the worst is over and we can all, it was a blip, right? The global pandemic was a bit of a blip in valuations and we basically don't have to worry anymore. Well, unfortunately, what I would say is if you add 2010 to this chart, so this is the same chart, I've just added 2010 to this, you can see that in 2010, half of the companies who raised a round of venture capital actually raised it at a down round, meaning they raised a round probably in 2007, 2008, 2009, and then in 2010, they had to raise more capital at a lower valuation. And what's interesting, and potentially not surprising if you understand the way venture works, is that there is a bit of a lag between, first of all, venture lags the public markets. But on top of that, if you think about the way fundraising cycles work, founders raise capital every 18 to 24 months. And so that means that right now, people are raising off of the revenue growth that they've had over the last 2 years. In 2021, they're going to be raising off of the revenue growth they're going to have in 2020 and 2021. And if revenue falls, if unemployment falls, all those, the headlines that we're all seeing right now, if those come to be true, we're really not going to see the impact of that venture probably until sometime next year or maybe even 2022. So unfortunately, I do think that from a valuation perspective, the worst is yet to come, and that we have not yet seen the impacts both on venture dollars, but also venture volume and venture valuations. I do think that all of those things is going to, we have not seen the worst of it. Just to go back in time a little bit, if you think about what happened in 2008, this is global venture capital dollars. And so you can see that even though the financial crisis hit, it did take a little bit of time for the venture market to correct. And there's a little bit of a lag behind when the public markets crashed. And so my suspicion is that 2021 will look very similar in terms of as valuations come. And then to exacerbate this, before COVID hit, we were already seeing a correction in the marketplace, right? So as we all know, we have been living in an incredible bull market, and venture has had money flooding into it. And so what has happened is you've had this great big ramp up, and there was already a correction in 2019 before COVID hit, and I think that COVID is going to exacerbate that. Now, what I want to talk about is why this isn't a terrible thing. But before I do that, I want to see if there are any questions about any of the data that I showed. I also went through it fairly quickly, but if there are any questions, I'm happy to take them. Otherwise, I want to talk a little bit about what this means for us. And again, even though those charts look really scary, why I actually don't think this is a terrible thing for investors or founders. I actually think it's a good thing. Take a sip of water. Okay, so I'm going to keep going, but please do ask questions as they come in. So what does this mean? So I think one thing that it means, which is a good thing, is that we are going to see a consolidation in seed. So seed capital is that first round of professional fundraising where you have founders raising from a combination of angels and VCs. In the US right now, I would say they're raising between $500,000 and $2 million, right? That's seed capital. And what you've seen is this flood of capital into seed in the last decade. And I think you're going to start to see a consolidation. So if you look at this chart represents the number of new funds created in the last decade. Last year, over 600 new funds were created. The vast majority of them being sub $100 million. And so you have all this money flooding into seed. And so what happens is that you have all of this capital, right? Supply has jumped up astronomically, but they're chasing the same number of good deals. And so you've seen this increased competition. And so I do think there are too many, especially early stage funds in the ecosystem right now. And I do think you're going to see some consolidation this year and next year. Some funds maybe aren't going to be able to raise their round at all. You might see some LPs, which are the limited partners investing in venture capital funds, default on capital calls. I do think that's going to happen. So you're going to see a consolidation. And add that to the fact that the vast majority of people who are managing funds today, by the way, I see there's some questions. I'm going to take a pause in 2 slides. The vast majority of GPs, general partners managing funds today, have never managed a venture capital fund during a recession. So 61% started this fund after 2008. And so they haven't experienced that. And what we saw during the great financial crisis is that fund managers who had managed money during the dot-com bust did way better than fund managers who had never managed before. So having managed capital through a recession leads to better results. And right now, more than half of fund managers have never managed a fund prior. Now, I know this all sounds like a bad thing, right? Consolidation of seed capital, but this is why I think it's a good thing. And I would argue this next slide that I'm going to show you is actually the scariest slide that I'm going to show you, which says this. It says that a decade ago, if you were to raise as a founder a seed or a Series A, you had about a 1 in 3 chance of raising your next round, your Series A or your Series B. However, today, if you were to raise a seed round or a Series A round, you only have a 6 or 7% chance of raising a next round of capital. And the reason why is, again, supply has jumped up in seed. So you have all of this capital in seed chasing deals, and you have companies that are being funded that shouldn't be getting funded, and you have a tremendous number of false positives. Now, for that to decrease, right, the number of false positives to decrease is certainly good for investors, but it's actually good for founders as well. And the reason why is because you won't have founders wasting 2 or 3 years of their lives working at a company that maybe shouldn't have gotten funded. But also, I think the war for talent will improve. supportive as well. For those of you who've just tried to hire a CTO or chief data scientist or a full stack developer in the last 5 years, it's been really, really hard. And so you have people who, maybe would make a great chief data scientist, but they're out there starting their own company, and now they can join forces with another amazing CEO, and I do think this will help the war for talent as well. Okay, I'm going to pause and take a few questions because I see a handful of them coming in. Okay, would you recommend waiting until 2022 to think about raising a new round of funding? I think that fundraising should be driven by startup need and should not be driven by market dynamics. I think that, obviously you can be a little bit nuanced about maybe, I would say, March 15th wouldn't have been the best time to raise, but I would say you should raise capital when your startup is ready for capital and when you need the capital, not based off the macroeconomic environment, since A, it's very difficult to predict, and B, as a founder, you probably can't wait 2 years. So I'd wait until you're ready. And what does ready mean for a seed round? Ready means that you have built a customer acquisition machine that is repeatable. You know how to acquire customers through Facebook ads or Instagram ads or direct email or trade shows or cold calling. You've built out that customer acquisition funnel. You know your customer acquisition costs and you know your customer lifetime value. And I, as an investor, am funding that customer acquisition machine. That's when it's ready to start raising capital. And if you're ready, I would do it whenever is the right time for your company. And I wouldn't necessarily think about the macroeconomic environment. So what are the primary sectors where VC funding is greatest at this time? Yeah, so sectors that have seen a lot of boon from COVID-19, certainly digital health is doing really well. Telemedicine, all the things that you would expect. So anything healthcare related, especially digital health, is doing very well. A second area is the future of work. So the future of work breaks into two areas. The first is supporting workers as they work today. And that could be part-time workers, that could be digital nomads, that could be people who are working from home, right? So that's one half of future of work. And then the other half of future of work is automation. And so this is robotics replacing human workers. So both of those parts of future of work are doing really well. Ed tech, not surprisingly, is also doing very well. Remote learning. Logistics tech is also doing very well. If you think about the idea of having data-backed ways of tracking trucking across the world is certainly an area that's seen a big boom. Cannabis is doing really well. Those are kind of the big sectors that we've seen a nice boom post-COVID. How can startups adapt to this new fundraising atmosphere? What strategies should be implemented to successfully raise during this time? I would actually argue, with the exception of the next slide that I'm about to share. So let me actually share the next slide and then I'll come back to questions. So I would say that as a founder, there's very little that you should do differently around fundraising, with one real exception. And that exception is that investors are having a renewed focus on the quality of revenue. So profit is a word that most VCs have not said for the last decade, and it has led to all of the headlines that we've seen around not being profitable and not being sustainable business models. And I think that this was happening pre-COVID, right? This is happening at the end of 2019 already, where investors were focusing on revenue quality and profitability and unit economics. But again, COVID, I think, has exacerbated and accelerated that trend. So I think the only difference I would make fundraising today versus 6 months ago is I would really talk about the quality of your revenue. So recurring revenue, long-term sticky contracts. Something that I don't think I talked about 2 years ago, but I'm talking about much more now, are what are your accounts receivable terms, right? Accounts receivables are, if my client is Target and I bill Target, do they pay me 30 days after I bill them, or do they pay me 90 days after I bill them? And that attention to cash and your statement of cash flows, those types of really detailed conversations we're having much more of. So I would argue really understanding the quality of revenue. I think that's the main difference. Everything else, I would say, do all the things that you would have done before, right? Leverage your network, really understand your problem, really understand your customer. Those things all hold true. I just have seen more of a focus on revenue quality. Have the dynamics being discussed held true within family offices? Yeah, I think family offices, I would argue as a whole, like a family office can be a single person taking 10% of their investable assets and investing it in venture, or it could be a multi-billion-dollar family office with 10 investment professionals focused on. Like, there's a huge range of what a family office means, first of all. And so the interest in family offices in VC has been growing over time. And I think the thing, if you think about people who don't do venture full-time, family offices being one of them, what happens in a downturn is that most, institutional investors, endowments, pensions, family offices will say, okay, I'm going to put 1% or 2% or 5% of my assets under management into venture, right? Most investment managers will do that because they want to be speculative and participate in that high upside. And what happens is, in a potential downturn when things feel scary, right? They used to have, let's call it, $100 million to invest, or, and 1% of $100 million is $1 million, right? So they would have $1 million to put into venture. But in April, when the market crashed by 30%, they now had $70 million of investments under management. And so they don't actually have any excess capacity to pull into venture. So I do think you're going to see a little bit of a contraction there. That said, every family office is quite different. I'm just going through questions. Oh, please define venture capital. My apologies. So let me define venture capital versus angel investors. So venture capital as a whole means that I, as a founder, I need $2 million over the next 2 years to pay for a team, to pay for Facebook ads, to pay for an office, all that kind of stuff. And as a founder, I have several different options of how I can raise capital. I can get a loan from a bank. I can go out there and make a ton of customer revenue, or I could raise venture capital funding, where I go to Andreessen Horowitz or Kleiner Perkins or Bessemer, and I say, give me $2 million in exchange. You own 20% of my company. And then hopefully that sort of gets acquired by Amazon for $100 million. And when that happens, the venture capitalist gets paid $20 million, which is 20% of the $100 million exit, and the founder keeps $80 million, right? That's the incredibly happy outcome. So venture capital is, as a founder, I am giving away a piece of my company in exchange for short-term capital to fund my business. So that's what venture capital is. What's the average size of the new funds post 2008? So average is, so to answer what's the average size of this new funds, so if you look at the top, you've got assets under management. So you could kind of average out, you can see the range, right? So the smallest funds are sub 25 million and the biggest funds are sub $500 million, but that's the range of the size of funds post 2008. Yeah, I'll talk about secondary markets maybe. Actually, I'll talk about secondary markets now. So secondary markets are, and this is true. So the network that I'm invested in, that I run, we're invested in Sweetgreen. And so let's say I wanted to sell my private shares of Sweetgreen on the public market. On the secondary market. I can do that through organizations like Equity Zen or Forge Global. And so I have to find a private investor who is willing to buy my private shares. And the problem with that is because it's a highly illiquid market, it means that A, I'm going to have to pay Forge Global and Equity Zen a transaction fee of between 5 and 20%, depending on the different platforms. And it's really illiquid. So I have to find somebody who believes in that selling price. And so the gap between the ask and the sell price is very, very large. So the secondary markets are still an emerging ecosystem where there is a tremendous amount of information asymmetry. So that is investor to investor secondary markets. However, you are seeing a lot of liquidity for founders. What does that mean? It means that I'm a founder. So I was at McKinsey with Neil Blumenthal of Warby Parker. And so we were there at the same time, and he didn't come back to McKinsey. He obviously went and started Warby. And maybe 5 years ago now, there was a big article how they got liquidated because they were raising their Series C or D. And what that means is the first round is a C round, and then you have a Series A, a Series B, a Series C, a Series D. That letter keeps getting higher as they raise more and more capital. And they were raising, let's call it their Series D. And so these founders had built an incredibly profitable, high revenue company. But because their entire investment was only in equity. Yes, that equity was worth millions of dollars, but they hadn't gotten any cash. And so what happened is in their Series D round, the venture capitalists who invested in that Series D round said, okay, let's say we're going to give you $100 million. 20 million of that is going to be used to give the founders some liquidity. We're going to buy some of the founders' shares and let them have some cash so they can do things like buy houses and, cars and pay for college education, all that kind of stuff. And I bring up them because there was an article written about how one of the 4 co-founders bought a Sesame Street house, where one of the former Sesame Street puppeteers used to live. And there was a very cute article about there. So if you Google Warby Parker and Sesame Street, you could read that article. This data could also just reflect increasing risk aversion of venture, which has been observed for 30 years. I would have a hard time speaking to that. I would argue that what the data has shown is that the money flooding into venture has increased. So I would say that would be the opposite of increasing risk aversion. My view on fundraising at this time, I think it's actually, I think it's a difficult time to raise a fund, but a good time to raise a fund. So if you have a potential LP base, right? So a base of people who you can raise capital from, I think it's a great time to start a fund. I think it's an incredibly difficult time to fundraise is what I would say. Because I think there's a ton, we are going to see more attractive valuations. I do think there's going to be some natural selection of founders who aren't going to start companies right now. And so the ones that do are the grittier ones. And so I think it's a great time to be an investor, but I think it's a very hard time to start a fund. On future of work, what about flexible office and co-working? Yep, some people would definitely put that into future of work. Some people would put that into prop tech, right? Property tech or real estate tech. It depends. There's lots of different ways to define sectors, and there are lots of overlaps. I am going to talk about diversity in a minute, so I'm going to skip that question for now. As a student interested in a potential career in VC, would you say this might not be the best time to pursue a career in VC? No, I don't think it's I think it's, again, a difficult time to get a job in VC because I don't think a lot of funds are hiring, but I think it's a great time to be an investor if you can get one of those roles. And so I would not shy away if you can get the role. We're only planning to raise $10 million for revenue and be profitable. Should we approach angel or VC? Most angels can't write a $10 million check. So if you need $10 million, you're probably going to need to reach out to VC. And then which sector will give you a higher valuation? Your company is in the sector that it is, and so you shouldn't game the sector of your startup for valuation purposes. You should pick the sector based off of what sector you have deep domain expertise on and what sector you're deeply passionate about. What percentage of VC investments break even, and what's the average VC return? So the goal of every venture capitalist is to do 3x your money in 10 years, which is a 20% IRR. So their goal is to turn a $100 million fund into a $300 million fund, which converts to a 20% IRR. That's what every fund manager will tell you they want to do. The reality is only the top 20% of funds are actually doing that. And the average venture return over the last 30 years has actually pretty much matched the S&P. But everyone is targeting 3x in 10 years, 20% IRR, but the actual numbers have pretty much matched the S&P. I am going to pause a little bit on questions, go through some more slides, and then I'm going to come back to questions. There are lots of them. Okay, so I did this slide. Okay, so I talked about a renewed focus on revenue quality. I think another positive trend coming out of all this is that venture is going to compete more by adding value, not on valuation. So what happens when you have a flood of money into the ecosystem? The supply goes up, and so valuations start to go up. And so you saw a lot of companies saying, I want to invest in your company. Maybe we think you're only worth $20 million, but we want in, so we will value you at $30 million. And it's why we've seen all of these crazy charts over the last 10 years where valuations just kept going up. And this is not a sustainable looking chart where valuations can't keep doing this. So I do think what's going to happen, given right now, is that we're going to see more venture funds competing on value, not valuation. So just showing a couple of firms that are adding a lot of value in the ecosystem. So Udisquare Square Ventures here in New York City, they have a manager boot camp, right? So once they invest in you as a portfolio company, they will run you through a boot camp to teach you how to hire, how to fire, how to sell, whatever the case may be. So that's a great value add. So they can say, look, your company is worth $20 million, maybe somebody else is offering you a $25 million valuation, but look at this value add we're going to give you. Human ventures and primary ventures are actually offering their founders coaching because being the founder is tiring and difficult, especially right now, and so they're offering them one-on-one coaching. For those of you who are, and this actually answers one of the questions about getting into venture, a lot of folks are interested in venture right now, but it's quite difficult to get a job on the investing side of venture. So there's what's called VC platform roles. And platform roles are, once I invest in you, I will support your company. I will help you with sales. I will help you with hiring. I will help you with branding. And so there are very, very many VC platform jobs that have emerged, which are supporting companies post-investment. This is a great resource to go to where you can, they have job postings. You can read about the rise of platform. And it's a really great thing to be, just to take a peek at. Another, I think the last trend I wanted to talk about is I do think that we're going to see the rise of alternative funding, right? So venture capital right now is what I just explained, which is you give me $2 million and then I now own 20% of your company through to exit. Sorry. Lots of things flashing. I think what's going to happen, so one of the good things about venture is it has made some people a lot of money, founders and investors included. I think the bad thing about venture, it is a virtuous cycle where previous success begets future success. And so it is a little bit of a rich get richer ecosystem, and it's very much a winner take all ecosystem. And I would argue venture encourages some behavior that is less than rosy. And so I think that you are seeing more of a rise of alternative funding. And I think this will increase. So venture debt is one example where it's exactly what it sounds like, as opposed to the investor owning a percentage of the company. Instead, they're lending capital. And then revenue-based financing is, instead of owning a percentage of the company, they'll say, okay, I'm going to give you $500,000 and you pay me back as a percentage of your revenue. And both of these are really appropriate for companies who maybe aren't going to become a billion-dollar company. They might grow a little bit slower. For those of you who want to read more about this, you can read Zebras Unite, and they talk a lot about funding companies that don't look like unicorns, but funding companies that look like zebras. And I'm very excited about this trend where we are going to see not only unicorns, which again are billion-dollar startups or potential unicorns, get funded, but we're going to see many more different types of companies getting funded. And I'm actually on the board of LunaCap Ventures, which was started by Paul Capon, who is a 2013 CBS grad, shout out to him. And he runs a venture debt fund, and I'm on their advisory board, frankly, to learn about venture debt because I do think it is a growing and booming ecosystem. Okay, so many questions. I'm going to see if there are ones that are some common themes and try to get to them. So how would you characterize VC target companies versus growth target companies? It's a hard question to answer. I would say it depends on the stage, right? So Series A companies, so seed, I would say once you have a repeatable customer acquisition engine, you can raise a seed round. Series A, you'll often hear, I want $1 million of annual recurring revenue, and then it goes up and up from there. So it really depends on the stage of company that you're fundraising for. What are some of the quantitative metrics you would evaluate in weighing the strategic decision between scaling quickly versus building sustainable? Yeah. Oh, that is a big question, Michael. So I think it's a personal decision. So what I always recommend for founders to do is before they take a drop of venture capital money, what they should do is sit down with their co-founders, at a table, and I'm a big fan of Post-it notes. And on a Post-it note, they should write down, in 5 years, what do I want to be doing? And what does success mean for me? And if all three co-founders say, success is I'm running $1 billion company and I'm still working 80 hours a week and I'm still not sleeping, all that kind of stuff, great. You all three should go raise venture capital funding. If one person says, I want to have moved on to my next thing, or I want to be working 30 hours a week, maybe I want to be caring for an aging parent, or I want to be living in Portugal, which is, a long-term dream of mine, those people can't start companies together. And so I think it should be a life choice, not a financial choice. And I do think that co-founders don't have enough of those conversations. And the reason why I say Post-its is everyone writes their answers and they slide it across the table and hopefully those answers match. But I think it's very much a personal choice. So we're invested in Alice app, which is enterprise software for hotels. And they just exited to Expedia. So the average company from seed to exit right now is 8 years. And Justin is a friend. He took a 6-week vacation. It was really the first vacation he'd taken in 8 years. And him and his co-founder got married during the whole process. And so to not take a real vacation in 8 years, I'm not saying you have to do that to run a really successful company, but you have to work really, really, really hard to run a venture-backed company. So I would say it is about lifestyle success and what that means for you, and that you're aligned within your with your co-founders. So I talked a little bit about new methodologies of new ways of raising capital. Is it a good time to fundraise? I think that the default should be to not raise capital to venture capital, and then only if you know it's a good thing to do it. I think right now the major reaction is, I need money, I should raise from VCs. And I think it should be, I'm not going to take VC capital unless it's the right thing to do. So when is it the right time to take venture capital money? You need to grow really fast, because this is a first mover advantage marketplace, and this is a winner takes all. And it's not really about differentiation. It's about being the first person to plaster the New York City subways with ads, right? Or whatever the case may be. That's when you should raise venture. And when you, again, want to run $1 billion company. But if 4 players can win an ecosystem and you can grow a little bit slower, then you don't need to raise venture capital funding. Long-term revenue is more easily realized in B2B. In B2C, where customer acquisition is more expensive, how is revenue quality likely to improve? Yeah, it's a good question. So I would say in B2C, the questions that we're looking for in that case are customer churn. We're looking for daily active users, monthly active users. Let's say you have a B2C app. How many times are people logging in a day? How many minutes is each session? If they download the app 30 days later, what percentage of those people still have the app downloaded, right? So there we're looking for customer stickiness and indicators of customer stickiness, which is harder than to do in B2B, where you can sign a 4-year contract. But those are the metrics that we're looking for in a B2C company around stickiness. When you think about the prospects of performance for investing during a crisis, how do you assess the risk-return proposition? Yeah, so what I would say is, not surprisingly, earlier stage is higher risk, high return than later stage. And I would say that's an assessment of your own risk profile. And in general, I would say that nobody should have more than 5 to 10% of their investable assets in this asset class. It's incredibly speculative. It should be a very small speculative part of your portfolio. But within that, allocating between early stage, late stage private equity, it's a more nuanced conversation that I can kind of get into right now, but talk to your financial advisor, talk to your life partners about what makes sense for yourself. Hi, Lavinia. From the perspective of an investor, VC is an asset class. Yes, it is absolutely illiquid. As I mentioned before, expect 8 years on average between seed and exit. I'm going to skip the IPO. Have you seen Asia Pacific IPOs? I can't speak to that, unfortunately. Can you discuss how private equity has been affected? Trying to think what I could say that would be intelligent about private equity. One of the trends that I will say about private, so if you look at the average timeline to IPO, I actually have a slide on this that I didn't include in today's presentation. What you have seen is that the value that has been created in private markets has been greater than the value created in public markets recently, because people are taking longer to IPO. So the definition of private equity is very different than the definition of private equity 10 years ago, because people used to IPO at a much earlier revenue stage than they do now. So private equity has seen a lot of the similar booms in terms of assets, money going in as recently. It's harder to say though, because private equity is more impacted by the IPO market than venture is. And so I can't give a super intelligent answer to that. And if I have time at the end, I will show you that slide. What is the minimum revenue required for a $2 million seed raise? It's less minimum revenue and it's more a repeatable process. I mean, I think a lot of seed investors will say, we want $50,000 to, $500,000 in revenue. But The real answer is we want you to have a repeatable customer acquisition process. We want to know that I have built a customer acquisition machine that when I inject dollars in, I get customers out of it. And as investors, as seed investors, we are funding that customer acquisition engine. And so we've seen customers, for example, we had a company that we looked at that was on Shark Tank, and they had all this revenue, but that's not repeatable. So even though they had at that point hundreds of thousands of dollars of revenue, we didn't invest because they didn't know how they were going to get their next $500,000 of revenue. So seed investors, which is what I would say a $2 million seed raise is, are looking for a repeatable customer acquisition process. What is your view on cloud and dark kitchens? I am not the right person to answer that, but I'll give it a shout out to Zach Schwartzman, who's also class of 2013 from CBS. He runs Metaprop. Metaprop is both a prop tech, real estate tech accelerator, as well as fund, and that'd be a great question to ask him. What makes a better return between GP, LP, and startup founders? Yeah, so GPs make more than LPs. And the reason why is because the way venture capital works is if I have a $100 million fund, every year I get paid $2 million in fees, and then I also get 20% of carry. So what that means is that if I have a $100 million fund, every year I get paid $2 million. So I get 2% of fees. And then if the 100 million turns into 200 million, meaning I make 100 million, I get to keep 20 million and the LPs get to keep 80 million. And again, the GP is the fund manager, the LP is the investors. And because those 2 million in fees are guaranteed, even if the fund does poorly, the GP gets paid in fees. The problem with startup founders is that averages are really dangerous in this ecosystem. So A, you want to look at median, and 2, you actually want to look at histograms of data. So I could tell you averages, but that's actually really not helpful. You actually want to look at the histogram of data. So the founders who've made a ton of money have made more money than the VCs who've done the best. But on average, right, so the average versus the tails are a very different story. Do I think generalist VC funds will face pressure on being more thematic? Maybe. I think what has happened, though, is by definition, as funds get larger, they become less and less focused thematically. And they have to be, right? Because there are only so many augmented reality companies in ed tech that one can invest in. So if that starts off being your thesis, and then you raise a $500 million fund, you will not be able to deploy all of that capital. So by nature, if you're a successful fund, your thesis will start to broaden. What has happened is that early, when you're a new general partner, when you're a new fund manager and you're raising your first fund, LPs want to see a thesis. They want to see a narrow thesis. I'm only going to invest in future of work. I'm only going to invest in automated vehicles. As you get more successful, they don't care. They just want to see returns. So I don't know. I don't know that will necessarily happen. Has your average check size increased over the last 5 years? Ours has not, right? We do 50 to 200,000, so we're seed investors. What, in my experience, so the way venture capital works is a fund will raise a 10-year fund. And so typically within the life of that fund, those 10 years, the check size will stay the same. What tends to happen is they'll raise a second and third and fourth fund if they do well, and those check sizes might increase, right? So Sequoia, I don't remember what the first fund was, but their last fund was $8 billion. You better believe that those check sizes are bigger. So within a fund, check sizes will stay the same size. Within a firm, as they raise additional funds, check sizes will go up. I don't know if the seminar is being recorded. I'm going to ask the organizers to respond to that. What was the name of the venture debt firm again? So I'll give 2 a shout out. One is Luna Cap Ventures, Luna Cap Ventures. And the second is, Star Capital by Spring Hollis. Star Capital. Another one would be Lighter Capital is another venture debt firm. What advice would you give in distinguishing which firms are more likely to achieve that 20%? Oh, if I could, that's like saying, what are the best mutual fund managers, right? But obviously, what are you looking for? You're looking for track record. So if they've had previous success, hopefully they'll have future success. You want to look for network. Venture is very much a network-driven business. So if they have a deep network, that would be something. And then domain expertise, I think, would be a third. And then I would say being a good human being, right? I think one of the nice things about venture is everybody does know everybody. And so I do think the jerks get weeded out. And so I do think that you want somebody who treats everybody with respect. And I think those people do better in life, but they certainly do better in venture as well. The book I mentioned regarding alternative funding, it was an article called Zebras Unite. Zebras Unite. Why is venture debt attractive? Venture debt is attractive because the default rate is lower than venture capital, because debt gets paid back first in the event of a liquidation, and venture debt has financial covenants where if your debt to equity ratio falls, if your cash in the bank falls, I can recall that debt. And so again, I like both venture debt and venture capital, but the proponents of venture debt would say that the risk is much lower because we can call back our capital because we put financial covenants into the agreement that says if X, Y, and Z happens, I can immediately call back my loan. But venture capital proponents would say you're taking on all the same risk as a venture capitalist with none of the upside. And I think, again, I would say participate in both asset classes if you can. Can I ask Laura or Kristen just type in Zebras Unite into the chat window? That would be great. Thank you. What is your perspective on special tax treatment of VC carried interest? I'm not going to get into tax treatment right now, other than the US is not the best place to be doing this type of investing. Other countries are better and have more favorable tax laws. In what scenarios are founders better off approaching angels versus VCs? I would say that, you're welcome, Alex. I would say that you're better off approaching, so VCs can write bigger checks. That's one big difference. And then in general, I wouldn't even think about it as angels versus VCs. I would just say diligence your investors, right? So talk to people that they've invested in the past, see who's helpful. I will say like a general stereotype about angels is so the positive things about angels are that they might be more flexible, right? Because it's an individual that doesn't have LPs to worry about. They can be maybe slightly more patient capital. They can write smaller checks and they might be slower to act and they might be less able to support a company post-investment. And then VC would be the opposite of all that things. However, what I would say is every venture capitalist is different and every angel network is different. And so diligence your investors individually. I'm trying to find, just because there are like 25 questions, I'm not going to get to them all. Yeah. Okay, so I'm going to do a few more slides and then I will see what other questions that we have. Okay, so our role as leaders, right? So I do want to talk a little bit about, when the chips are down, what are the things that we should be doing as leaders? Because I think it's an important thing to talk about above and beyond, venture capital valuations. So, with 37 Angels, we're invested in 70 companies. At the Lang Fund, we're invested in 55 companies. And so I've been having a lot of conversations for the last 2 months with founders about how we can be helping them. And so I want to talk about just a couple of tactical pieces of advice. And the first thing is, how do you work with a distributed team? And so I just wanted to offer up some different resources for you all about how do you work with a team that is all over the world, maybe working in different time zones. I particularly like the top right one, the Year Without Pants. Fun fact, Walmart did like a product rationalization and found that during quarantine, people have been buying 3 times the number of shirts versus pants because we're all wearing PJ bottoms, right? And trying to look a little bit more professional. So I thought that was fun. Big shout out to Deep Work and Rework. I really love both of those books. But these are just about how do you be an effective worker? How do you think about setting boundaries between home life and work life, given that we're all working, all over the place right now? The second thing is about customer acquisition. So I've talked a lot about customer acquisition, and it's really important that founders know how to do customer acquisition. So if you're a founder or you're advising a founder, helping them to think through customer acquisition. So highly recommend this book. There are several books called Traction, but I would recommend the one by Gabriel Weinberg, and he walks through the 19 different customer acquisition channels. And so how do you do each of these different things? And so it's a really great handbook and primer on how do you acquire customers. But even more importantly, some of these can only be done face-to-face. So if your primary sales channel was at conferences and tabling, for example, how do you pivot? So I think understanding customer acquisition is a great thing. On a more kind of personal level, I think all of us who know founders should be checking in with them about mental health, right? So think about how many times a day you ask somebody, like, how are you doing? Your response is fine. Like the next time, just be like, no, how are you really doing, right? Like, things have been really crappy lately. I have been crying more than usual because of everything happening in the world, and it kind of feels like the world is on fire right now, right? And I think it's very important for us to be checking with each other and helping each other through these things. 2 resources for you all. The first one, which is Real Talk Movement, is specifically for founders. So they have founder stories, they have founder resources, they have founder help groups where people are talking to each other about how difficult it is right now to be a founder. So I would recommend that organization. And then the MHA Mental Health Toolkit has a plethora of resources. I love quizzes where I can quiz myself on things, but they have worksheets, they have quizzes, and it's a great way to, I think, destigmatize and give people real tools and tactics about how to overcome mental health. So it is something that I think is really important that we are still focused on right now, given how scary the world can feel. And then one of the very first questions was around what is happening given everything happening with George Floyd. So I think without the Black Lives Matter movement, my fear is that post-COVID, what would have happened is that we would have seen diversity fall a little bit on everyone's priority list. And I'm glad that there is the sentiment we have right now, because that's not happening, right? People are not allowing diversity to fall by the wayside. And so I think that's a good thing. And it's a good thing because as much as we've all been talking about diversity over the last however long, the numbers haven't really changed, right? In terms of dollars going to female founders, in terms of dollars going to founders of underrepresented minorities. And by the way, if you look at the female number and the Black number specifically, that also exactly reflects percentage of VCs that are Black and female, right? So it's not surprised that people writing checks look a lot like the people that they're writing checks to. You know, one that we don't talk a lot about is founder education as well. So a fun statistic for you all, which is if you look at the people who are getting funded by venture, 27% of them have Ivy League educations, compared with 0.3% of grads every year. That is a 900%, 900x multiple. So the people who are getting funded look like the people who are in venture capital. And so I think it's really important for all of us who are investing or working founders to try to change some of these charts so that 10 years from now or 5 years from now, they don't look like this anymore. And so one thing that I would encourage all of us to be doing is to be diversifying our pipeline. And so, you know, working with accelerators that are supporting diverse founders, also sharing deal flow with other investors who support diverse founders. I want to give just a shout out. X Factor Ventures focuses on female founders. Angels focuses on founders from the LGBTQ community. Defy Ventures focuses on founders who are formerly incarcerated. New Voices Funds focuses on Black female entrepreneurs. And so there are many, many more than this, but I just want to give some of them a shout out and encourage all of us who are in the investor seat to be co-investing with them and diversifying our pipeline of deal flow that we see. And then once you get that founder into the room and you're having them pitch and you're asking them questions in diligence, to check your bias as well. So what this research, I should say, came out of Columbia Business School. Donna Kantz was a PhD student here, and she found that regardless of the gender of the investor, when we asked male founders questions, we would ask them promotion-based questions. How are you going to become the next unicorn? And when we asked female founders questions, we would ask them prevention-based questions. How are you going to prevent Google from stealing all of your market share? And so as investors, we need to check our own bias and ask everyone similar types of questions. And while this data was done on gender, I anecdotally have seen this play out with founders of all kind of disenfranchised groups. And so for the founders on this call, if you get asked a prevention-based question, answer the prevention-based question, but then answer the promotion-based question they didn't ask you as well. So that's something. And then after you invest in a company, encourage them to be more inclusive in their hiring. So when 37 Angels invest in a company, we tell them, Now that you're invested, we want you to have more inclusive hiring practices around recruiting, hiring, and retention. So Matheson, for example, gives you a more diverse pipeline of talent. Textio takes your job description and removes words that are biased, right? So if you say things like, I'm looking for a data science guru, expert, ninja, rock star, women, people of color are going to be less likely to apply to that job. So it will de-prejudice your job description. HireVue and Blendor both do the same thing, which is when you look at a resume, it will take off any identifying characteristics, so you can judge that person based purely off of their capabilities, not off of their demographic information. And then Fairy Godboss is like Glassdoor.com, specifically for women, and it's focused on, does that company have inclusive practices? And so you can read about your own company. For those of you who are looking for jobs, look up the company on Fairy Godboss and see if they are an inclusive place to work. And then Everfi does really fantastic diversity training, which for those of you who are working at larger companies and they need diversity and inclusion training, I would recommend Everfi. Okay, I'm gonna take a couple more questions and then wrap this up. How does this apply to life science VCs? Nothing particularly different, other than there's an interest in life science, obviously, given everything happening. Do I think public market valuation is overheated? Probably, but there's probably. How do you select a good item to start? Pick a problem you deeply care about and you have domain expertise in. That's what I would say. And obviously an attractive competitive landscape. If you're an EMBA and interested in VC as a career, what electives would you recommend? So on the venture capital side, there's Foundations of Venture Capital, there's Entrepreneurial Finance, there's VC Seminar, there is New York Immersion in Venture Capital, and there is Launching Social Ventures. Those are the ones that I can think of right now. And then Entrepreneurship Through Acquisition. Those are the big ones. And then for those of you who are not current MBA students, there is a new exec ed course on venture capital, which I teach as well. So there are lots of ways to learn about venture capital. Do seed funds invest in startups with just prototypes? I would argue just prototypes is pre-seed these days. So I would look for pre-seed funds like Precursor Ventures, A4 Ventures, AFORE. Pre-seed funds, Dash is another pre-seed fund. That's probably a better fit for prototype only. If you want to start a career as an angel investor, you should join an angel network. Typically most founders won't take less than a $25,000 check. Is there any appetite for funding brands? Absolutely, plenty VCs fund brands. If you want to transition into VC, I would start with certainly a VC internship and roles in VC adjacent careers. So that might be working at an accelerator, it might be working in corporate VC, it might be working at an angel network, but you probably want to start off with something VC adjacent. Maybe you work at VC platform and you can go to vcplatform.com and look at their jobs. And then you probably want to do a couple internships with VC and then move into it. It is very much an apprenticeship model, and it is a highly coveted career path, so internships are helpful. What percent of ownership do angel investors? They usually will get less than 1%. So a very typical math is a $25,000 check into a $5 million company. So they have 50 basis points or 0.5%. Connect with new VCs through your network. This is a very network-driven ecosystem, so go on to LinkedIn and find your second-degree connections to those VCs. That is the best way to do this. Given the abundance of VC, yes, so the question is, has there been a flood towards seed? Absolutely. So that's what some of the charts I was showing. There's been definitely a flood towards VC. Are there any female VCs that would be a supportive environment for female VCs? So certainly, I mentioned before, X Factor Ventures. There's BBG, Built by Girls, which is through AOL Ventures. There is, wow, oh, Female Founders Fund. There are more, they're just escaping me, and all my friends are gonna be mad at me now that I didn't give them a shout out, but those are the ones that I can think of right now. Okay, so I've gotten most of those questions. Oh, can I talk about the role of content marketing? It's hugely important for those of you who want to be in the investing space, I think, to develop some sort of brand for yourself, right? Whether that's through hosting great dinners like Ed Zimmerman does, or having a lot of writing like Fred Wilson on abc.com, or Brad Feld on his blog, or by writing a book. I think it is increasingly important to have a brand to rise above the noise. And some people are using platform to build content and brand as well. Okay, to wrap us up, I wanted to remind us of Mr. Rogers. I don't know if everybody knows who Mr. Rogers is, but he was a TV show host who had a lovely children's show. And he was just the most wonderful human being in the world. And Tom Hanks actually just played him in a biopic, I guess. And he used to say, look for the helpers, right? When things get crappy like they are right now, look for the helpers. And so I wanted to give a shout out to a couple of helpers within the CBS community. One is Laws of Motion, is a startup that does micro sizes to have very inclusive sizing in their clothing. Started by Carly Bigi of the class of 2017, and she has been donating masks and gowns and face shields to mostly New York medical institutions. And I want to say, I heard this, although I didn't see it in writing, but I did hear anecdotally that she's the #1 donator of masks and gowns in New York State. So she's doing awesome work. So go and support her if you can. And then Ethan Brown is the founder of Beyond Meat, one of the 10 unicorns that have been created through Columbia Business School. And he has pledged to donate over 1 million of his vegan burgers. And he has this great ambassador program where people can nominate food banks and hospitals to get free burgers. And he has ambassadors like Kevin Hart. You can see this photo was tweeted by Snoop Dogg, because Snoop Dogg is one of the ambassadors. So they're both doing great work. So I wanted to give them a shout out since they're both in the CBS community. And I wanted to encourage all of you to be helpers as well, right? So I know we talked about a lot of numbers, a lot of tactical stuff, but I also just wanted to take this as a moment to say there are over 300 people listening to this right now. I think like 1,400 people signed up. So if you're listening after the fact, like, take one of the things I talked about and see if you can be a helper and do good. If we can harness the collective energy of the leaders on this webinar, we can all start to be the good that we want to see in this world. And so I know we're ending on a little bit of a cheesy note, but it is a very sincere note for me, which is that when things seem awful out there, I think that's a time for us to step up. And every one of us on this webinar is a leader. And I would encourage us to be the helpers in the world that we want to be seeing. Thank you so much. Thank you for all the engagement and all the questions, and stay safe out there.